Welcome back. It's time for Overlooked Stocks, and George Tsilis is here, senior markets correspondent. He's taking a look at restaurant brands QSR, which is up 0.9%. Got an upgrade over at Guggenheim. Tell me a little bit about this name, which hit 52-week lows, and it was down to 59 and change. What's doing?
Well, I mean, I think, there's a lot of activity out there from the standpoint of looking at, value potentials. And I think QSR, which is denoted as Quick Serve Restaurant International. And here in the United States, the brands that we're familiar with include, Burger King, Popeyes Chicken, and Firehouse Subs, of which those last two are growing quite a bit, about 30 to 40%. But this is a Canadian company. It's actually the largest restaurant chain in Canada under the Tim Hortons brand, which is the coffee house and baked goods company. And based on some of the data that's provided, about 80% of Canadians go to a Tim Hortons at least once a month. This is, again, based on surveys. So, but if you look at the stock, it doesn't really reflect the popularity of the brands. There are some struggling components of their business, particularly the Burger King business has not been growing, at the very least here in the United States or internationally. But like I said, the smaller percent of revenue businesses, Firehouse Subs and, of course, Popeyes Chickens, those two have actually grown 30 to 40% over the past year. And Tim Hortons still around the mid-teens in terms of growth. But there is some technical damage in the stock. It's down about 18%. And there are some analysts now with the earnings coming out for the business on February 10th. They're establishing their footing with some price action or price settings. Oppenheimer actually upgraded the stock recently to an $83, and Guggenheim today actually moved their price target down to $71, but they increased their rating on the name to buy from a sector weight, basically a hold rating. And one of the reasons I think is happening here is, if you look at the chart for this particular name, Nicole, if you look at it from the standpoint of since late September, interest rates are really impacting this business. Now, the dollar has been very high. It's pulled back, as you mentioned earlier in your previous segment, over the past week or so. The international sales repatriations back to the United States have been a challenge for QSR, but also the balance sheet. And what I mean by this is, if you look at the balance sheet, it's quite hefty in terms of debt. So higher interest rates, refinancing needs also put some price pressure on the stock. But underneath the business, if you look at the composition of their total breakdown, about 62% of total outlets are actually company-owned, whereas about 38% are franchisee-owned. So this certainly makes a big difference in terms of the analyst estimates going forward, because there's a possibility that QSR decides to spin off some of their company-owned franchises, company-owned stores into franchises. And that is one way to recapitalize the balance sheet, pay down some debt. So that's certainly a possibility, and I think some of these analysts are on board with that potential.
Yeah, I mean, look, we think about these names and what the consumer is feeling, and feeling the inflation and the pinch, and should they shop at the market? Should they eat out? Any final thought? Because they do face this inflationary pinch in the purse.
Yep. Yeah, you can see that. You can actually see gross margins of their businesses, system-wide, which is all their operating units, are down over the last from a 5-year average. So their cost of goods have been very high. I think that's also why the stock has been down over the past year. But I think right now, if you consider valuation into 2025, the stock is trading around 16 times this year's earnings, which again they're going to be finalizing Q4 of 24. When they report in February. But at the same time, historically speaking, the stock trades at around a 5-year multiple average of 22 times. So it's trading at a discount to those levels. And then lastly, I'll point out this, even though there's technical damage on the 1-year chart, if you look at a 3-year weekly chart, it's right around that 200-week moving average. And I use that as sort of a longer-term proxy of support for stocks that, again, have been at least oversold in the last year, but it's holding that 3-year level of support, which is that 200-week moving average.
All right, George, thank you so much. A great overlooked stock there with an upgrade, and actually some other positive calls too.